The word liquidity sounds intimidating. It's a heavy, institutional term that confuses a lot of beginners. But in practice, the concept of liquidity is simply a mechanical trap designed specifically to catch everyday retail traders. This chart shows what liquidity actually is, a specific location on your screen where average traders hide their stop losses. Beginners put safety nets here, get stopped out, and panic. Professionals use that exact panic as a profitable entry. Once you understand how to locate these zones, you stop being the one getting hunted and start exploiting the trap yourself. Step 1 is establishing our baseline. Open your charting software and set it to a higher time frame for a clear look at the raw data. We are looking for a swing low on the 1-hour chart. Scan the historical data for a major drop in price that was aggressively bought back up and draw a hard line at the absolute bottom. That line represents traditional support. It is the psychological floor where average traders look at the chart and feel safe executing a buy order. But because everyone feels safe buying there, they all do the exact same thing. They place their automated safety nets directly beneath that floor. This layout shows what that behavior creates. Identify the empty space directly beneath your support line. That dense concentration of money is your liquidity zone. If price dips below this line, thousands of stop losses trigger simultaneously, creating a massive pool of forced sellings. Large institutions need enormous volume to fill their orders without moving the market prematurely. A concentrated pool of panicked sellers gives them exactly the inventory needed to strike. Now that we have our macro zone marked, we have to zoom all the way in to precision time the entry. As the current price approaches your critical support zone, toggle your chart interface from the 1-hour view down to a 1-minute or 5-minute view. Watch the price action closely as it slowly bleeds downward toward the 1-hour line you established. Do not buy early. Getting in right at the line is the classic beginner's trap, and you know their stop losses are about to be hit. Wait for the sweep. You'll see the price violently pierce the support line, triggering those retail stop losses in a sudden, pressurized burst of selling volume. That sharp breach looks scary, but it isn't a genuine market crash. It is a deliberate institutional sweep designed to harvest liquidity from early buyers. This shows the precise signal to act. Watch a red candle pierce the support line, followed by a strong green candle pushing back over it. Patience is mandatory. You must wait for that green candle to completely close to confirm the trap. That sudden upward surge tells us the market makers have finished absorbing the panic selling and are now driving the price higher. The exact moment that green candle closes, execute your buy order. Now look at the diagram to place your own safety net. Set your new stop loss strictly just below the wick of that newly formed green candle. Keep in mind, this specific setup frequently fails on the first attempt. It is completely normal to get stopped out once while the market continues sweeping the zone. You must maintain that strict stop loss. Take the small hit, reset, and be emotionally prepared to execute the exact same setup a second time if the candles reform. Replacing emotional guesswork with this strict rule-based execution sequence guarantees that your entries align with actual institutional market flow. This chart shows successful setups. A clean liquidity sweep often triggers a massive upward trajectory, easily capturing hundreds of points. Notice the difference in scale. This massive profit margin heavily outweighs the tiny losses from a failed first attempt. Next, practice. Open your charting software. Scroll through the previous week's data and locate 3 historical examples of this exact sweep pattern. Identifying these patterns in historical data trains your eyes to spot the trap. Doing this in a risk-free environment is the mandatory final step before you ever deploy real capital into live markets.